Media and Biz Talk Today TV. Welcome everyone to the Torres Report. I am your host, Todd Schoenberger, and joining me as he always does every week is José Torres. He is the senior economist at Interactive Brokers. José, welcome to the program. We have to talk about Nvidia's earnings. The number came out yesterday, 73% revenue growth, truly remarkable. You have a record number of data centers that they're actually that they're involved with, but the stock's down 5%. It doesn't add up. What do you think about that? What's Interactive Brokers talking about when it comes to Nvidia?
Great to be here, Todd. Well, what's going on is that Nvidia always dishes out a beat and raise, and what investors are looking for here are signs that the artificial intelligence cycle is in its beginning stages. But unfortunately, Nvidia's earnings reports and commentary from CEO Jensen Huang failed to really provide that reassurance that there's a long runway ahead. Of course, there's a lot of constraints with the technology. Even in the State of the Union address, President Trump mentioned the power needs of the tech companies. We're talking about electrical constraints, water constraints, that are essentially, hampering the prospects ahead. Then also we heard about Anthropic and that those AI solutions potentially disrupting other areas in the market. So take that together, and essentially folks are saying, well, maybe the AI gravy train is towards its end rather than its beginning. And for that reason, folks decided to sell tech shares today. But folks did dive into treasuries. Yields are going down. Despite stronger than expected economic data, claims were better than projected. And that really drove a little bit of a bid into the rotation trade, the reacceleration trade. The Dow and the Russell are modestly positive. They're expected to benefit from an environment of reaccelerating growth and a few rate cuts. So that's really what's been happening today on Wall Street. The issue is, though, if tech can't start to gain momentum, Todd, we're probably going to have a down year in stocks, because those cyclical or old school kind of names in the market, they have valuation caps. They don't have those narratives of earnings and revenues doubling and tripling every 3-4 years. These are more steady Eddie kind of firms. So for those kinds of corporates, for them to counter the weakness in tech, it's just very, very difficult for them to do that.
Well, don't say the negativity word. That would be awful. We don't want a stock market to sell off. We want things to continue to go up in that 45-degree angle on that chart. But with what you were talking about with the jobs data, and we'll get into the jobless claims in a moment, but AI is known to take away jobs because of productivity shifts. Are you a believer of that, though?
No, I think that it's going to create new jobs. We've seen in the past. I love to bring up the bank teller example. When the ATM machines came out, folks thought that, wow, we're not going to need any financial services employees anymore. But then all of a sudden, we had a lot of other different services come about. So we don't really know how AI is going to change the game. I still think that, generally speaking, when you look around globally, you have demographic issues, you have aging populations. So there's still going to be opportunities for those younger folks to get into the labor force and to do something. Maybe not something that you're thinking about or considering right now, because you don't know what's going to happen in 10, 20, or 30 years. But I think there's going to be opportunities to do something. And of course, those that are determined, hardworking, and prepared, they can go out there and they can do things. It's a labor shortage situation, folks. It's not an abundance of unemployed people that we have. And like you said with the claims, Todd, you alluded to, there's not a heavy appetite from corporates to want to reduce the workforce that much. They want to keep their workers. Labor is cheap. Labor is not expensive.
Yeah, I agree with you on that statement. Every time we've ever had new technology introduced, there was always this fear that it was going to take away jobs. The calculator came out and everyone thought math teachers were going to become obsolete. And then you had the internet come out. It was, oh yeah, retailers are going to be obsolete. Now you have AI. Oh, everything else is, the only job that's going to remain, it sounds like, José, are economists, but we'll have to see what happens with that.
Todd, the retailers, talk about technology.
Yes.
The shoplifting went through the roof
right?
Okay. And now you need people there. You need a few people there. You don't
You got to
have
have some
maybe as
humans.
many cashiers, but you got some bouncers, you got some security guards, you got some police officers, you got something. So that's, that's something to consider too.
Yeah, and like my friend Jeff Mackey would say, you can't have a relationship or a friendship with an ATM. You have to have that individual there. That's how you create loyalty amongst your customer base. Let's talk about those jobless claims though. You have a number that was the lowest single, what was it, first time filers, the lowest since September. The 4-week average is very steady, Eddie. It's probably the only metric that has been steady these days on Wall Street. So what does that tell you about the labor picture? Because it seems a lot stronger than what I'm hearing, but you explain.
Yeah, no, it's very complicated right now because you don't have that much labor supply. You don't have that many workers that you can hire. So, in the payroll numbers are capped. You don't have the immigrants. You have a closed border policy.
Yep. Okay. You still there,
So,
Jose? All
ability
right.
to work in agriculture, construction, retail, hospitality. Yeah, I'm here. Okay. Whoa,
You are
can't.
back. Yes.
Hey,
We
I'm
lost
here.
you for a minute.
Am I back?
Yeah.
I'm back. Sorry. The immigration situation, you don't have a lot of the workers that would otherwise work in manufacturing and construction and agriculture and some of those low skilled jobs. You don't have that supply there. So that's really hampering the payroll additions. Those are a lot weaker, but the unemployment rate is still low. The claims are low. It's pretty healthy economy overall. You had a lot of retirees too. The aging demographics we were talking about, hard to replace those boomers that have been specialists in their fields. So I think we're in a good environment. Continuing claims too, also reflecting positivity. Job openings still doing all right, not as elevated as in the past. Consumer spending bolstered by all of this, of course. We've been hearing about the consumer not doing well for so long, but somehow, Todd, they continue to come out, they continue to spend. Really remarkable. And I'm expecting, I mean, why count them out now? Why count out the consumer now? Not much of an incentive to save for real estate purchases because affordability is really stretched. Household formation is also down. So you're expecting these folks to continue spending on services. You look at the prices for concerts, for entertainment venues, for airline tickets through the roof. People are out there spending, they're having fun. And that's really translating to an environment where we can expect corporate America's earnings to continue growing, albeit the weakness in AI in the tech sector, that's a separate story.
Well, the positivity that came out of the State of the Union address from the president, speaking of how great things are, the economy is roaring. He is talking about it. We saw mortgage rates for the first time since 2022 today have dropped below 6%. That's got to be a big plus for the real estate market. But what do you think?
I've been telling folks, Todd, since we started the series earlier in the year, stocks could be flat. I know you don't want me to say that, but the bull trade has been treasuries. You want to get into treasuries. I was on CNBC last Friday. I told the crowd the 10-year is going to break below 4% decisively. Right now, it's at 402, expecting that to occur. Mortgages below 6. I'm already hearing from realtors that folks are calling and they want to buy because for them, they look like, Todd, like you said, they look at the mortgage rates. As soon as it's below 6, all of a sudden now monthly payments make sense and they want to go out and they want to buy things. So that's a great story. Hopefully the tariff revenues, of course, the Supreme Court rejection that hurt the momentum a little bit, but hopefully the tariff revenues can sustain themselves because that, Todd, is really helping to bring long-term bond yields down, including mortgage rates, 10-year Treasury, 30-year, because when you have those revenues, 200 to 300 billion a year, that alleviates the budget deficit situation and it helps borrowing costs. So that would be a tremendous development, especially to offset a weaker tech sentiment. You can really get the Dow and the Russell to start gaining a lot more. The Russell's up already 6% year to date. The Dow is up around 2.5. That can become double digits by mid-year if you have GDP, strong consumer spending numbers, and rates coming down. Worse, dishing maybe 2 to 3 rate cuts this year, and you can have a double-digit year in the Dow of maybe 10%, in the Russell maybe 25%, even if the Nasdaq is flat.
Yeah, that's a good point. That's a very good point. We hadn't talked since last week on the Torres report, and since then you brought it up, the tariff ruling from the Supreme Court. What are your thoughts? What are you guys talking about at Interactive Brokers? Are we going to see any type of a situation where we're going to have to rebate countries back with the money that we've already assigned tariffs to?
No, we think that that possibility is very low. We believe that the administration is going to maneuver. They've been preparing already to get rejected by the Supreme Court. Our prediction market, Interactive Brokers, we're competing with the other prediction market venues out there. We don't do sports, but we had the Supreme Court contract, and we essentially it was around 75-25. The Supreme Court were going to deem the tariffs illegal. So folks were prepared, investors were prepared, and the Trump administration is now going to try to maneuver and use those other sections of the of trade laws and of trade acts that were passed in the 1900s to try and justify those tariffs. So we think that the tariffs are sustained. It's clearly, like you said, with mortgage rates, clearly mortgage rates and the Treasury yields agree as well, because we saw when the Supreme Court first rejected the tariffs, yields rose and stocks rose, but now we're getting the opposite move. Yields are falling, Todd, and so are stocks, because you're not going to have that much of a short-term tailwind from those refunds, which would bolster corporate earnings in the short run. But then also you don't have those worrisome trends in the fiscal deficit space. We've been making progress on the deficit, and my expectation is we're going to continue to do that, which is a great story that needs more coverage, folks. The deficit is getting better. Let's not focus on the nominal amount and how big it is. We all know it's huge, but the point of direction, where are we pointing to? And we're pointing to a narrower deficit, and that's great.
Yeah, valid point there. So the PPI number is coming out tomorrow. And as you remember, Jose, January 2025, you were on many shows of ours at BTT, and it was piping hot. And so I would think that the year-over-year rate is going to just, cut in half. But what are your thoughts?
Yeah, I think we're coming lower here, definitely bolstered by lower energy costs. The PPI is really levered to gasoline, jet fuel, diesel, those categories. So looking for a number here at 2.6% year over year. Month over month, we're looking for 0.3. So a little strong month over month based on trade services. But overall, 2.6, CPI 2.4. Everyone, for whatever reason, is focusing on December PC numbers that were up at 3%. But I think you got to focus on CPI here. Forget about PCE for the time being, because the majority of deflationary pressures are coming from shelter and housing, which is a direct benefit of the administration's immigration restriction policy, bringing down housing costs, lowering rents. And that's seen in the CPI, which, back in the day, the Fed used to use the CPI a lot and prefer the CPI. But then because housing costs were rising too fast, and in my opinion, the central bank wanted to find an indicator that was going to permit a looser monetary policy, they switched over from the PCE. But now, if the Fed wants to pursue a looser policy, ladies and gentlemen, they should switch over to the CPI. Because of lower housing costs, it's going to be lower than the PCE. Roughly 45% share in the CPI housing shelter, roughly half of that in the PCE.
Jose, the PCE index, everyone talks about how it's the preferred gauge, the preferred data point for the Fed when they're making their decisions on monetary policy. Has that always been the case? Has the importance been that high on PCE, say with a Chairman Greenspan or Volcker?
No, I got to go look back at the history books, but I want to say 2002, 2003, they switched over from CPI to PCE because of what I said earlier. Housing costs were really levitating, and they had to really find an indicator that was going to justify looser policy, lower rates, bigger balance sheet, accommodative policies, and that really shifted over to the PCE. But now, because for a long time, Todd, the CPI was always higher than the PCE.
Okay, right.
Now it's lower.
Now it's lower. Well, it does bring up a good question, though. Is that why would, and I'm asking the question, but why would if the PCE is so important, and I can never understand this, then why do we even have a CPI and a PPI?
Well, the CPI question is that's a tougher one, but the PPI that's unique because it really measures the change at the wholesale level, at the intermediate level. So it tells you kind of what's going on down the pipeline, not just what's happening, at final prices. Of course, final prices are pivotal for the households, but also it doesn't really tell you about margins, right? Producer price index tells you a lot about margins. CPI and PCE, I think that it's two different agencies, really, the Bureau of Economic Analysis, the Census Bureau, and the Bureau of Labor Statistics, my employer from 2016 to 2018. The CPI is used more as it's a better representation of what consumers spend on, right? So for example, the PCE has a 25% weighting in housing. Todd, you and I both know most households don't spend just a quarter of their income on housing. It's like 40%, 45%, in some cases 50, 55%, right? So for that reason, I think the CPI has value, but the PCE is more comprehensive and it covers many more categories. And it's less about what sellers are pricing products at, more about what consumers are paying for. So it's a little bit, you have these granular differences between the two. But as an economist and as a realist, I prefer the CPI at this juncture because when I look at its components, it's a much better representation of what Americans are spending on. And housing, PC underestimates the impact that housing is having on Americans, and it's a big one. Housing is incredibly expensive, and I think the CPI is representing that and those lower costs. So I've been favoring the CPI for a long time.
So, final question for you: next Friday is going to be the all-world, all-important jobs report for February. We are going to get this number at 8:30 Eastern time Friday morning, and there are 0 government shutdowns we have to worry about, 0 delays, hopefully no snowstorms in Washington. So with all of that said, have you looked at and given or thought of a forecast, or is it premature to ask?
No, you can ask that. 50,000 jobs. I think that the unemployment rate stays steady. We're not going to get these ridiculous jobs. I think you're going to have downward revisions to the last month. January's report, the one that came out in February for January, was very high. I don't think that's an adequate representation. But we're going to have around 50,000, a downward revision to maybe around 65,000 for January.
65,000. Wow. Okay. That can move the needle. There's no doubt about it. So we'll see.
Yeah, we'll see what happens with the unemployment rate, see what happens with the composition. Really, it's been healthcare driving all the job gains. None of all the other areas are like, oh, well, I think corporate America is in this mindset side. Okay, these are the employees we have. We don't really want to take risk by letting these folks go and trying to find new ones because we don't think there's anyone out there that could do this. So we're kind of just keeping our headcounts stable across the economy, and healthcare, because of demographic reasons, aging population, and just a long-term shortage really of workers in the healthcare space. That area is just adding incredible amounts. In fact, January to January, 9 out of 14 of the major sectors lost jobs in the last 12 months, which is crazy. Incredible. In a strong economy, non-recessionary.
That's crazy. I know in the media space, the jobs are just being cut left and right, but across Check Media, we are actually hiring. And so we are growing leaps and bounds. And so that's a good sign. Maybe it's just a shift from the general traditional media to the streaming new age media. So maybe that's what it is. We'll have to see. Jose, I want to thank you for joining me on the Torres Report. I can't wait to see you next week. We will give a preview for that jobs. We already talked about it, but we got to break it down a little bit further because that's going to lead up. That's the final jobs report before the next Fed meeting. So I know we're going to talk all about that. So Jose, this was fantastic. I can't wait to see you again.
Great to see you, Todd. Ladies and gentlemen, thanks for joining us, and we will see you soon.
You got it. All right. So on behalf of José Torres at Interactive Brokers, I am Todd Schoenberger. Thank you once again for joining us on the Torres Report. We'll catch you next time. Take care.